An incumbent management team being invited to take a minority stake in a private equity buyout must have their eyes wide open to what private equity investors expect and what is possible to negotiate to improve the private equity opening position. There needs to be a balance between looking at the benefits of being a part owner of the business, with the expectations of profitable exit when the private equity investor sells in 5 or so years' time, and being realistic that private equity investors are not the same beast as a traditional family-owned business. If the investment is not performing to their high expectations, private equity investors will be ruthless, make changes, and could even sack incumbent management, and management should be aware that the outcome will be that a management exit increases the share of the equity of the private equity investor. In the investment agreement, things to look out for include handcuffs on the ability of the management to manage the day-to-day business. What obligations could trip you up and put you in breach? And a breach means that you can be sacked and your shares taken away for no or minimal consideration. Often, the Articles of Association contain the devil in the detail. It could define the circumstances when your shares have to be sold: death, illness, dismissal, resignation, redundancy. The key point is, what do you get for your shares? This will depend on whether you are classed as a good or a bad leaver. A good leaver gets a fair price. A bad leaver will get a heavily discounted price. You need to fight to get redundancy classed as a good leaver. Sometimes it can fall between the two stools and is classed as an intermediate leaver, with a price on a sale between the two extremes. Most of the money from both the management and the investors gets invested in as a loan. Ideally, your loan terms should match what the private equity investor gets on their loan, but they don't always see it that way. Private equity investors love having different classes of shares with different bells and whistles attached to each class. Be very clear about what rights and restrictions you get, and take tax advice so you know the tax consequences of making the investment into shares. There's a big difference between having the profit from selling your shares taxed as income or taxed as capital. Be clear that the deal must be structured so that your shares will be taxed as capital and not as income. As existing employees of the target business, your tax position can be very different from the private equity investor. In summary, management teams should be prepared for hard negotiations, lots of no's, and sometimes for the goalposts to change late on, and for the business to operate differently under private equity ownership. But management teams that make it all the way to when the private equity investor does exit can see some really good returns. Our work often includes guiding management teams through the process of being involved in a private equity buyout and seeing their investment through to a successful exit.